Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic I want to discuss with you in full detail annuity riders and really dissect the pros and cons of annuity riders, why they were put into place, how they could be beneficial for an individual situation, and then most importantly, how individuals think of annuity riders as actual guarantees and growth, guaranteed growth into contracts. So I want to decipher some of the BS out there regarding annuity riders, show you when annuity rider might be justified for your individual situation, and allow you to really see how they were implemented and then which product lines to leverage for the best annuity contracts, particularly to your age, particularly to your situation, particularly to your state. So all those different things come into play. Now, one of the things that I mention in majority of my videos about annuities is I say that, annuities are the exact opposite of life insurance. So when an individual is purchasing a life insurance policy, they're paying dollars to an insurance company, and what they're doing is they're protecting themselves in case they pass away too soon. So what happens is this person usually pays monthly premiums, annual payments, whatever that might be. And what it does is those premium payments are utilized by an insurance company to leverage the law of large numbers, meaning millions of individuals that are paying those same premiums for a similar type of insurance to make sure that there is a lump sum death benefit that could get paid out to this individual's beneficiaries. So if they're going, let's say they're 30 years old and they go and they're paying $100 a month, that might provide them $1 million of death benefit coverage to say, God forbid, if this individual is to pass away from now until the next 10, 20, 30 years, however long that coverage is, the insurance company will come out of pocket and pay $1 million of a death benefit to the beneficiaries. So they're paying the annual or the monthly premiums to therefore get a lump sum from the insurance company in a tax-free manner. So annuity contracts are the exact opposite of that. And to understand the generic concepts of an annuity really comes into play with understanding how an annuity rider works and why they were first implemented. So rather than protect an individual from dying too soon, an annuity contract is supposed to be established to protect an individual from living too long. So essentially, like a given example would be, let's say if somebody is currently age 60 and they want to retire at age 65, and they say, okay, I have a bucket of money, I have $100,000, and I understand that I want to retire at age 65, and at age 65 I'm going to have $10,000 of expenses at that time. So what this individual typically does is they try to invest those dollars or keep this dollar safe, and then maybe grow it from $100,000 to maybe like $110,000, or whatever that case may be, depending upon whatever the risk is. But if they didn't do anything, essentially what would happen is at age 65 they now have a bucket of this $100,000, and they have to siphon through $10,000, $10,000, $10,000. So if, let's say, there was no gains, no losses in this individual's bucket and it was just sitting in a cash account, we understand that this individual would outlive their money by 10 years. Or within those 10 years. So they might have retired at age 65. By age 75, they have no more dollars left, and now they have to pull from an additional bucket. That's obviously a problem. This is a problem that insurance companies understood, where they wanted to try to leverage the law of large numbers. They wanted to try to leverage their actuarial data from life insurance to be able to provide a type of benefit for these individuals from living too long, from outliving that 10-year mark or 15-year mark or 20-year mark, whatever that case may be. So what they did was they originally established a basic type of annuity contract which says an individual pays the insurance company a lump sum dollar, so the opposite of life insurance. And what happens is, so this individual is paying lump sum to the insurance company, and I apologize for my sloppy handwriting, and then what the insurance company does is they say, okay, if you're doing this at age 60, we could give you a guarantee of, let's say, $10,000 for the rest of your life starting at age 65. So what this does is it's leverage of saying the individual says, okay, I think that's a good deal because at age 65, I want to retire. I need exactly $10,000 of income to live off of. So what this does is it protects me. Every year that I live past that age 75, as opposed to leaving it in a cash account, this annuity stream keeps paying me that $10,000, $10,000, $10,000. So in theory, if this person lives to, let's say age 95, they would have paid the insurance company at age 60 $100,000. The insurance company would have been paying them back $10,000 each and every year, and they would have been able to receive back payments of $300,000. So this is considered a win for the individual and a loss for the insurance company. So in that very basic example, what are the risks to the insurance company, and then what are the risks to the actual individual? And with this basic type of annuity, it's known as annuitization. So this is where the individual is surrendering control of that, in this case, $100,000. And where the insurance company could win out is, let's say, if this individual passes away, let's say he starts triggering income at age 65 and unfortunately comes down with an ailment and passes away at age 67. So in that case scenario, the insurance company would have paid him $10,000 at age 65, $10,000 at age 66, then the person passes away, so the insurance company was able to utilize those dollars, invest those monies on the back end, gain interest off of those dollars, pay 2 premium payments of $10,000, and then get to keep an $80,000 profit on top of the money that they were making for those 5 years and those 7 years of interest. So this is where the insurance company wins. That's the problem with annuitization, is this individual is betting against the insurance company. The insurance company has hundreds and hundreds of years worth of data to really understand on an actuarial basis how long this individual is supposed to live. So if somebody's age 60 and they're triggering income at age 65, well, the insurance company understands the law of large numbers that says, okay, we could still be profitable because some individuals are going to be passing away, before that 10-year mark. Other individuals are going to be living past that 10-year mark, but we're able to then therefore take all these lump sum dollars, invest it on the back end, have new monies coming in to therefore pay for those old monies coming out, and whenever the person passes away, now we have that extra profit that's there. So that's the problem with annuitization. And please rewind this section so that everything makes sense, because this is the generic shell. This is why individuals have really started getting pissed off with insurance companies when you had those old-fashioned type of annuity contracts and that old-fashioned benefit of just annuitization. And what I mean by that is, like, a more realistic example would be an individual that says, okay, I'm age 65. I'm currently age 60. I want to retire by age 65. And I need to pull out income when I retire. I have Social Security income that's going to come to me. Maybe I have a company pension plan that's going to come to me, and I have this lump sum dollar amount of $100,000. So at age 65, rather than a $10,000 benefit from the insurance company, maybe the insurance company is going to give them a $5,000 benefit of lifetime income. So it says, okay, at age 65, now that break-even point is going to be age 85. So every year past age 85, the individual is dipping into the insurance company's pockets, and therefore it was a good move for this individual. If this person passes away before age 85, well, then we understand that it's a win for the insurance company, and the insurance company got to control the trips the entire process. Now, annuitization is broken down to a couple different factors. You have single life income, and that's going to pay usually the highest payout because that's going to be the riskiest play. You have joint life income, kind of like how a pension plan works. You have a single life option or a joint life option, meaning that if you and your wife, own or you and your spouse own one of these annuity contracts, and one person passes away, well, then the money will still grow, or will still come until the second spouse passes away, and then that payment stream will stop. So maybe on a single life individual, they would receive $10,000 of lifetime income, but on a joint life, maybe it will be $5,000 or $7,000. So therefore, it's going to be a reduced benefit because there's a larger risk to the insurance company to cover 2 lives as opposed to 1 life. You have also different things known as like period certain, like 10-year period certains, where they're saying they will pay out for exactly 10 years. After the 10th year, everything's going to stop. So it's going to mimic exactly how pension income streams work if you're familiarized with how pension plans work. Once again, that still does not make annuities good contracts with annuitization. This is why a lot of individuals, they started getting pissed off because they realized that, the insurance company controls the chips. They understand the actuarial data better than anyone. They're making pure profits off of this. So therefore, there was a lot of individuals that stopped using annuities for their income streams and started just using it as like a fixed interest credit or an index interest credit, and were not, ever triggering that annuitization option. So therefore, insurance companies started to get smart, and they understood that there was something known as an annuity rider that they could create as an additional, as a supplemental benefit for contracts, for annuity contracts, that an individual could leverage to say they're not surrendering full control of their monies, and they're able to still leverage the insurance companies to provide a lifetime income stream. So which are the 3 main annuity products that offer annuity income riders? Those are fixed annuities, fixed indexed annuities, and variable annuities. Variable annuities were actually the first ones to start that off in early 2000s, and they wanted to really take care of the market share as what I think is more of a bait and switch type tactic. And I'll get into the generic shell of everything, and then also go into specifically where an income rider comes into place, or annuity rider comes into place. Because I keep talking about the income play on annuity riders, but there are also death benefit and long-term care riders and all these other features that an individual could add onto their annuity contracts. But what exactly out of these three contracts, what is the generic shell of a fixed annuity, a fixed index annuity, and a variable annuity if you were not attaching any income riders to that type of contract? Or should I say account? So like the way a fixed annuity works is it's very similar to how a bank CD works. So like when an individual goes to a bank and let's say they're receiving a 5-year bank CD, currently bank CDs are paying, as low as 1%, let's just call it 2% to be favorable. If an individual goes and purchases a bank CD and it's 5 years and it's at 2%, and this person has $100,000 that they invest, we understand the interest in year 1 is going to be $2,000. Interest in year 2 is going to be $2,000. Year 3 is going to be $2,000. So what happens is after those 5 years, this individual is still going to have their principal left over of $100,000, and then they gained, $10,000 of interest off of those 5 years. A fixed annuity, a bank CD is obviously owned through a bank, so they have their tiers of safety through a legal reserve system. And a fixed annuity, all sorts of annuity contracts have to be offered through insurance companies. So there are accounts offered by insurance companies, and fixed annuities pay typically a little bit more favorable. So sometimes about 1%, 2%, 3% higher than what a typical bank CD pays. So like right now, fixed annuities are paying, like a 5-year fixed annuity is paying right around 3% or 3.10%. So what that says is if you invest that same $100,000 and you're trying to just live off of that interest each year, you're going to get $3,100 the first year of interest, $3,100 the second year of interest, $3,100 the third year of interest. If you don't touch those dollars, then you have the power of compound interest versus bank CDs that has simple interest that compounds. But essentially what happens is with a fixed annuity, you got to think of that like a bucket with a lid over it. Every year, if you're getting a 3% interest credit, if the market goes up, you're getting 3%. If the market goes down, you're getting 3%. So 3% is going to remain fixed at all times into that account. So if this person's living off of the interest each and every year, they're going to pull out $3,000. So a 5-year fixed annuity paying 3% would provide this person $15,000 for really easy math of interest, of basically interest payments. And then at the end of those 5 years, this person now has the $100,000 of original deposit. The reason why I bring that up is because individuals used to utilize bank CDs and annuities, fixed annuities, with their high interest paying years, like in the 1980s, 1990s, when an individual was able to get, a 12% fixed annuity or a 10% bank CD. It was really easy for the retirement income the retirement income landscape, because all you'd have to do is go into a legal reserve structure backed contract, live off the interest each and every year, still have your principal that was left over after the X amount of years of term that you've leveraged for those contracts. So there are still fixed annuities without income riders or without riders in general that you could have, and it just works like a very easy type of contract. Now, a fixed index annuity is the second type of contract. This came out a little bit after the fixed annuities back in the 1990s, and what it said was individuals wanted to try to have gains tied to upward stock market indexes and still have that peace of mind that if the market goes down, they're going to receive 0%. So what this did was it tried to combat inflation and purchasing power risk by leveraging a fixed index annuity. So very similar to that bucket with the lid over it, like I said, with the fixed annuity. Let's say if you were in a 5-year fixed index annuity and it had a 10% cap and it was tied to an S&P 500 index, and this is just a hypothetical example. Let's say that the S&P 500 index gained 10% that first year, then it lost 20% the second year, then it gained 7% the third year, then it lost 30% the fourth year, then it gained 12% the fifth year. How exactly do the credits work with a fixed index annuity? And it would say, okay, year 1, if you have a cap of 10% and the gain was 10%, you're going to have a plus 10% gain because that's what the market did. Year 2, there's a cap of 10%, a floor of 0%. So when the S&P 500 lost 20%, you gain 0%. Year 3, you would have a gain of 7% because it's underneath the cap of 10. Year 4, the market came back minus 30, you would have a plus 0. And then year 5, because it gained 12%, you're going to have only up to the cap, which is plus 10. So essentially, when we utilize all these different interest credits, we understand that this was a 27% gain total, as opposed to, let's say, a 5-year fixed annuity that was paying 15% gains total. So this is where mathematically the fixed index annuity made more sense. It gave that person gains whenever the market went up. So it's like they're opening up the lid, pouring the gain inside anytime that the market goes up, but you're gaining 0%, meaning that your money is protected each and every year that the market index comes back negative. That's the generic shell of a fixed index annuity. Now, a variable annuity is exactly what it says. It's variable. So what happens is this is tied to the market, and it's tied to very expensive mutual funds. So the generic shell of a variable annuity, we have to think of a bucket with a lid over it, but actually poke a couple of holes in the bottom of this bucket. And what those holes are mutual fund related fees, mortality and expense related fees, insurance related charges, turnover ratio. You have a whole slew of different things. You might have advisor fees that are associated with this bucket. All these different things that it's trying to gain whenever the market goes up, and this is why it's investing in a variable account. But when the market goes down, this individual might have anywhere between 2% to 5% in fees in a given year off of a variable annuity because of all these different factors that come into play with these fees, and then sometimes advisors tack on an additional advisor fee to quote-unquote monitor this account. So what this is saying is, let's say if you're only paying 2% in variable annuity related fees, and let's say the market goes down, your mutual funds go down 10%, well, this is like having holes in the bottom of your bucket and then slashing a 10% cut off of this type of bucket as well. So if somebody had $100,000, and let's say you're paying $2,000 in fees and the market lost $10,000, well, starting your second year, you're going to be walking into the year with $88,000. So it's going to go up when the market goes up. So you have uncapped market gains, but you also have uncapped market losses. So like 2008, you could have gotten hit with a minus 30% loss. On top of it, you also are paying all those fees. So that's the generic shell of a variable annuity. It's tied to mutual funds. It's riskier than fixed. It's riskier than fixed indexed. It has uncapped gain potential, but you also have uncapped loss potential as well. So individuals usually utilize fixed annuities for their generic shell when they want to have growth. Fixed index annuities for their generic shell with no riders when they want to have some growth. And then variable annuities to keep down the cost, they utilize that in their generic shell without adding any sorts of riders to those types of programs or those types of plans. Understand that all the fixed index, and the variable annuities all have that feature of annuitization where they say, hey, if you want, you could also trigger a guaranteed lifetime income stream, but you have to surrender full control of those monies, full access to those monies. So this is where individuals said, hell no, I don't want to do that. I only want to use an annuity contract, a fixed annuity contract, or a fixed index annuity contract, or a variable annuity contract, specifically just for the growth play, and just live off the interest each and every year. And the reason why individuals don't utilize that annuitization feature is because they know if, I pass away too soon, now the insurance company keeps all my money, no monies get left over to my beneficiaries. It's me versus the insurance company. Hopefully I'll live long enough to get into the insurance company's pockets, but that's not guaranteed. So it's very important to understand that if an individual does not use annuitization, well then whatever's remaining in their account balance would get left over to their beneficiaries upon their death. So it's just like any sort of cash account or any sort of, you could purchase annuity contracts with non-qualified monies like cash accounts. Like let's say if you sold a house, you sold a business, you could utilize non-qualified annuities for that. A very attractive feature is the IRAs. IRA contracts could be set up through annuities to give you, because utilizing, IRAs are used for retirement monies. So there's different features that you could leverage with insurance companies and their annuity contracts to make sure that your retirement accounts are growing on a safe, consistent basis, or at least being leveraged the correct way. So please understand that an annuity rider is just an additional feature that you're attaching to that generic shelled product. So if you have a fixed annuity and you add a rider to that, well then it's adding, kind of like a bucket with a lid over it, it's adding an additional shell over it, and that rider is providing some sort of benefit. Same thing within a fixed index annuity, like a bucket with a lid over it with that generic shell over it, and then a variable annuity, like a bucket with a lid over it with a couple of holes on the bottom and some risk. With that, that there has to be a generic shell over a generic benefit. And what exactly are the benefits of annuity riders, or how to really expose crappy annuity riders from good ones for your exact situation. And the most common type of annuity rider is something known as an income rider. And that's exactly what it's doing. It's trying to provide lifetime income without annuitizing those contracts. So without completely surrendering control to the insurance company, what they're saying is if you add this feature onto your type of contract, then you could be receiving lifetime income through the form of a rider. So what that means is that in a generic sense, let's say if you have that individual that's age 60, wants to retire at age 65, they have $100,000, and let's say they want to get placed into a fixed index annuity with an income rider, and let's say that that income rider is going to provide them $10,000 of income at their age 65. Well, from ages 60 to 65, their physical money, something known as an account value, is growing when the market goes up, gains 0% when the market goes down, just like how I showed you on the generic shell of a fixed index annuity, and then you have a secondary calculation account. It's not your real money, it's a calculation account known as the income base that is rolling up by a specific percentage, and then when this person wants to retire, it's going to be a calculation of income base multiplied by something known as a withdrawal rate percentage, and that's how the company determines what that lifetime income is. So let's say if this person goes and they're age 60, and they understand if they go with company A that's providing a fixed index annuity with an income rider, and let's say that income rider is going to give them $10,000 of income at age 65, well, what happens if, just like that first example, this person passes away at age 67? Well, their account value is gaining when the market goes up, gains 0% when the market goes down. When they start pulling out money, those monies are being negated from their account value. So 10,000 is coming off of it, 10,000 is coming off of it. And let's say that there was no growth in the markets during those years. Well, you have $80,000 that's now still sitting in the account value. Rather than the old-fashioned annuitization, now $80,000 could get left over to the person's beneficiaries. So that's the benefit. So what you're doing is you're leveraging the insurance company, and just like that other case where it says, well, what happens if you live to your age 75? Well, if you live to age 75 and let's say you have no more money left in your account value, well, now you're dipping into the insurance company's pockets and they're still on the hook to pay you $10,000, $10,000, $10,000. So if this person goes from age 65 and let's say passes away at age 95, the insurance, they were able to have that peace of mind that if they passed away before that break-even point, all the remaining monies in the account value would get left over to the beneficiaries. So the individual's winning on that aspect. And then if they live past that break-even point, which is, in this hypothetical example was age 75, now they're receiving $10,000 extra dollars. So now they have pure profit of $200,000 that they were able to dip into the insurance company's pockets for. So in theory, annuity riders sound fantastic. In reality, you still have the greed with insurance companies that they're the ones that are offering these types of riders. So it's all about finding the sweet spot. It's all about finding the individual situation, because let's say if you have, and there's over 1,200 different contracts and strategies and different benefits and different choices that an individual could choose with annuity riders in different companies. So for an individual that's, let's say, living in the state of Florida that's age 60 and wants to trigger income at age 65, well, company A might come back in first place because that's providing the highest income, the highest cash flow. Maybe that's giving this person a 7% cash flow as opposed to company XYZ and company ABC and company, M and N. Maybe they're only providing a 5% cash flow, maybe a 5.5% cash flow, maybe a 4% cash flow off of those dollars. So it makes more sense to go with company A at that point in time. Well, maybe if this person wanted to trigger income at age 67, Company A is not going to be the best route. Maybe it's going to be, an entirely different company altogether. CDE is going to come back in first place, and with an 11% cash flow. Whatever that case may be, it's very important to understand that each company has their own specific niche. And that's when I say we want to cherry pick what the best company is, what the best contract is. Your situation being age 60 can be completely different than somebody else that's age 68 that's looking to trigger income at age 70. All because you have an annuity rider that works really well for the 60-year-old does not mean that that same company, that same annuity rider and contract works really good for that 68-year-old that's only waiting 2 years of deferral as opposed to a 60-year-old waiting 5 years for deferral. So the insurance companies are very smart. They understand that if individuals knew that concept, they would be trying to cherry pick. So what you have is a lot of this smoke and mirrors and what I call bullshit out there that says 7% annuity guarantee, 10% guarantee on your money, 5% annuity guarantee. What exactly does that mean? And what I'm telling you is it's not a true value. It's not a true guarantee on your physical money, on your physical account value. It is just a portion of a roll-up on that calculation account that tries to justify certain fees getting paid out or certain individuals placing dollars into those annuity contracts. So what exactly, when I'm saying a 7% guarantee versus a 5% guarantee on an income annuity or on an income rider, what exactly are the difference between company A that has a 7% guarantee and company B that has a 5% guarantee? And before I go over to the next screen, be mindful that an annuity rider, let's say an income annuity rider, it's all based upon a calculation. The calculation these companies use different terms for, one might call an income base, one might call it a PIV account. They're all the same sort of generic calculation. It says at that point in time when the person's looking to trigger income, in order to determine how much income they will receive, it goes by whatever that income base is or that income account is, multiplied by the withdrawal rate percentage. This withdrawal rate percentage is determined on a per company basis and might be entirely different from one company over the next. So when you're looking for the calculation, don't just look at the one half of it that says, oh, the income base is higher, so therefore it's going to give me more income. No, it's income base multiplied by withdrawal rate percentage, and that's what equals lifetime income, and that's how you're able to look underneath the hood to determine whether an annuity rider is necessary or whether you're looking at that annuity rider and say, go with option A versus option B. Why does it make sense to do so? So the easiest way I could explain this is by showing a side-by-side comparison off of 7% guarantee versus a 5% guarantee. So this is the BS that I want to expose to you guys. Company A says they're going to give you a 7% guarantee on your money. Company B says they're going to give you a 5% guarantee on your money. And you realize that all they're talking about is the income base. So in order for that calculation, what did we say? Income base multiplied by withdrawal rate percentage equals that person's lifetime income. So if we have an individual that's age 60 and they say, I don't know whether company A or company B is better, and we're just going to use simple interest for this example. If they have $100,000 to invest in company A or $100,000 to invest in company B, and they're trying to use the best lifetime income, well, it says that this person's age 61, his income base, so this is the other side. This is not the account value. This is not their physical money. This is just the calculation account. Income base would be 107 the first year, 114 the second year, 121, 128, 135. Company A, by the time the person is age 65, has an income base of 135,000. Company B, 105, 110, 115, only has 125,000. So when you're looking at this, you say, oh, well, 7% is obviously higher than 5. 135,000 is higher than 125. I'm not an idiot. Obviously, Company A is going to give me a higher result. And understand that larger numbers do not automatically equal bigger results because we still have that second component of withdrawal rate percentage. So if we have Company A that has a withdrawal rate percentage for a male age 65 of 4%, and Company B has a withdrawal rate percentage of 5%, when we calculate those numbers, Company A might provide $5,400 off of the original $100,000 deposit, and Company B requires will pay out $6,250 off of the original $100,000 deposit. These numbers are very important because when they look really close together, that's just going off of a $100,000 example. How exactly can you determine what's the smallest amount of dollars to place into an annuity contract using the best income rider versus another company? And let's say if somebody needs, just a random example, $20,000 of income by the time that they hit age 65, how much do they have to place into one of these contracts or with company B by the time they hit age 60? So this is where the concept of cash flow comes into play. Is we understand company A has a 5.40% cash flow at age 65. Company B has a 6.250% cash flow at age 65. So therefore, if the $20,000 is the goal, we take $20,000. Let's say if you made the mistake and you went company A, divided by 0.055400% cash flow, means that this person needs to put in $370,371 into company A to provide $20,000 of lifetime income. $370,000, remember that number. Company B, that has a 6.250% cash flow, we use that same example, divided by 0.06250, says $320,000. So this person was able to save $50,000 of less money going into company B as opposed to company A because this had a much better income rider, even though everything on the surface was saying, oh, 7% guarantee. This is the BS, this is the fluff that insurance companies try to manipulate so that individuals get suckered into contracts. And company A is still not a bad contract, but what I'm trying to say is you could save thousands of more dollars in retirement by only leveraging these annuity contracts for the smallest amount of dollars into those plans and only as much as necessary. So there's a couple of different steps with annuity riders. If we're looking at an income rider, well, obviously we want to make sure that you're using the best contract or the best company that's providing you the highest income. Don't attach an annuity rider onto your contract if you don't need, do not attach an income rider onto your contract if you don't need income. If you're strictly trying to just grow your accounts, well, understand that these income riders typically have a fee associated with it. Like fixed annuities, if they have a rider, it's usually a little bit less than 1%. Fixed index annuities, it's usually a little bit less than 1%. Variable annuities usually have that fee of a little bit over 1.5%. Variable annuities, the reason why I don't like that is because they have a bunch of hidden fees that are associated with there. Right now, as I'm filming this video in 2017, fixed index annuities with income riders typically are paying the best out of all income rider related contracts. So like if you're coming to the table and you're saying, okay, I need $20,000 of lifetime income within the next 6 months or within the next 7 years to get triggered to correlate to my expenses, if we have the best variable annuity, typically that might give you, let's say, a 5% cash flow versus the best fixed index annuity with an income rider might give you a 7.5% cash flow. When we do our analysis, we make sure to incorporate all types of annuity contracts out there, all over 1,200 plus points of data to make sure that we could give you accurately, dependent upon your state, dependent upon your situation, you're able to place in the smallest amount of dollars and only as much as necessary into the best contract. We're an independent agency, so therefore we work for the client, we don't work for the company. We represent all companies out there, every single one possible, also proprietary relationships to make sure that we can accurately educate you the right way and to make sure that we can always put you in the best position with whatever the best contract is paying out. Sometimes individuals don't need income, but they want to have a nice death benefit growth. Maybe they're not eligible for life insurance, they're deemed uninsurable, so you could utilize like an annuity rider, like a death benefit rider that will have a specific roll-up on that where showing you that income base is not your real money. They have like a death benefit base where that could get paid out to your beneficiaries upon your passing. So it will roll up by 5%, 7%, whatever that case might be, that you're looking to utilize it. So sometimes death benefit riders work really well. Long-term care riders usually coincide with income riders. So the way that would work is, let's say somebody's receiving $10,000 of income and they have a long-term care doubler rider on there. What it would say is if you come into a long-term care scenario, they will double your income to $20,000, or you just basically double your income for, sometimes they have minimums of like 5 years or until your account value hits zero, and then it'll drop back down to the original amount. So there's a whole slew of different ways, there's a whole slew of combinations that you could do. The most important aspect is to do not fall victim to the common mistakes, do not fall victim to the traps, and just say, oh, I've heard of this contract, or oh, I heard of a 7% guarantee, that sounds great, because it's not a true guarantee on your money. It's not a true value on your money. Your money, depending upon which annuity contract you go with or annuity account you go with, a fixed annuity is going to be paying interest on a fixed side. A fixed index annuity is going to be paying interest when the market goes up, pays 0% when the market goes down, and a variable annuity is going to be paying interest when that mutual fund performance does well, and it's also going to negate your account value when that mutual fund performance does bad, along with a bunch of other fees associated with that. So right now, in current times, the fixed index annuity with income rider, and this is what I like to call the hybrid annuity, is usually the best play for an income side or even a death benefit play. So in closing, I hope you found value in this video. If you have questions at any time, please feel free to give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service, so there will always be someone there to pick up your phone call. And you're going to be talking to an assistant and say, okay, I saw a video on Annuity Riders. I was interested in asking further questions. I want to speak with a specialist. So they can patch it over to you as, with that standpoint, and then you'll talk to whatever the next specialist is that is available. The other thing that you could do is you could go on fosseyfinancial.com or retiresharp.com. It's both going to take you to the same website, and we have this little feature over on the bottom right-hand side that allows you to schedule an appointment specific with that strategy specialist. So typically this works better if you want to have a more concrete time to call in and make sure that you're getting the best specialist possible. So this is why I recommend to go to our website. We just put that feature on there about a month ago, and it's been really, really great with with feedback from clients and prospects. Education is key for retirement success. That's what we try to do, is we try to educate individuals first and foremost, really look at their 30,000-foot view of their situation, see what their current situation is, see if they could accomplish their goal with their current situation, and then give recommendations, slight tweaks, to make sure that they can accomplish their goal successfully. Sometimes we leverage annuity contracts, sometimes annuities are not necessary, but whatever you're getting set up into, it's always very important to make sure that you're doing it the right way, that you're not wasting thousands upon thousands of dollars in the wrong direction. We want to make sure that you're always satisfied and you're being taken care of the right way. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. That's because of this methodical process. I want to thank you very much for watching this video, and please feel free to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. Thanks so much, guys.